Welcome everybody to the YouTube channel of FAST CPAs and Consultants. As usual, here we are with our CPA, Fulton Abraham Sanchez. How are you, Fulton? Welcome.
Fine, Monica. Thank you.
Great.
How are you doing?
I'm fine, thank you. Excited for the topic we are going to have today, in fact.
Definitely.
Well, for the new ones, we are doing a video series called Tax Talk, where we are going to talk about the different tax strategies that you must follow according to your situation. All the questions we mentioned in the videos were received through our social networks and email. Today, our fourth topic is about the foreign earned income exclusion. So be ready and take note. Fulton, shall we start?
Yes, shoot me.
Perfect. Question 1. What is the foreign earned income exclusion?
Okay, the foreign earned income exclusion, or FEIE, is an exemption created by the IRS or within the Internal Revenue Code that allows all expats, US expats, those US citizens and US residents living in a foreign country to not be taxed on the first $110,000 of income. But this income earned in the foreign country must come from a company for an employer in the foreign country who is paying to the Social Security Administration in that foreign country. That is the basic requirement. Any other type of income earned for consulting, royalties, dividends is not covered by FEIE, the Foreign Earned Income Exclusion, is not. It must come, the first $110,000, it must come from payroll earned in the foreign country, paid by the company in the foreign country, and this company in the foreign country paying contributions to the Social Security in the foreign country.
Okay, thank you. And how do you qualify for the FEIE?
For the FEIE, or the Foreign Earned Income Exclusion, you qualify if you are an employee in a foreign country and the company in the foreign country who is employing you is contributing to the Social Security. There is no other criteria.
That's clear. And what qualifies as foreign earned income?
Salary, only salary received from a company. There is no any other consideration but salary, payroll.
Got it. And what is considered foreign income for tax purposes?
Foreign income is anything, any other income, any type of income that the US expats or the US citizen living abroad or living in the US earns from any other source outside of the US, any other source. This could be consulting income, dividends, royalties. Even if there is a company in a foreign country that is accumulating profits and the profits are not distributed, the US citizen is obligated to account or to include the profits as income, even though there are no distributions. In the US, there is the requirement for worldwide earned income. It means that any income that you earn outside of the US of any type from any other source is taxable.
Understood. And how can double taxation be avoided on foreign income?
There is one way of the treaties. There are treaties between the US and different countries. There are treaties between Mexico, between Israel, treaties between France, Spain, UK. And the objective of these treaties is to avoid double taxation. It means that if you have income in that foreign country and you pay taxes in that foreign country, then that income will not be taxable another or again here in the US because it's already taxable there. That is the virtue of the double taxation treaties. there is no way or there is no reason to have or to pay two-time taxes for income that has been taxed already in the foreign country. That's one way. Now, remember, that only applies to any other income that is not related to payroll, because payroll is under foreign earned income exclusion. So payroll doesn't apply there. There is already $110,000 exemption. This applies to any other income that is not payroll, because payroll there is already a exemption. That's one way. With treaties, double treaties written or signed between the US and different countries. For those countries that don't have treaties, there is another option. There is the foreign earned income, the foreign earned tax credit. It means that even though there is no a treaty of double taxation between the two countries, there is the IRS or the Internal Revenue Code allows you to claim taxes paid in the foreign country as a credit when you report the income in the United States. But you have to claim those taxes in form 1116, that is foreign earned income tax. So that's the two ways. One is through treaties, and the other one, when there's no treaties, you can claim the foreign earned income tax credit.
Perfect. And do I have to pay tax on money transferred from overseas?
No, you don't have to pay taxes when you transfer money overseas, because usually you pay taxes. You send the money overseas when your income is already taxed. Now, remember, you don't have to worry about the taxes that you have to pay when you transfer money overseas. What you have to worry is that you file your tax returns in the United States and in the country where you reside if you are an US expat, and there you pay your taxes. When you file your tax return, you don't have to worry in the middle of the year that you are wiring money. I have to pay taxes, I don't have to pay taxes, because that is irrelevant. It's irrelevant when you wire money in the middle of the year or at any time of the year. The relevant thing is to file your tax return and pay taxes with that tax return in the United States and also in the foreign country.
Okay, I see. And how much money in gifts is tax-free?
According to the Internal Revenue Code, every single US expat and US resident can gift money up to $14,000 to any person. There is an exemption for the wife, for the spouse. For the spouse, there is an unlimited gift tax exemption. You can give to your spouse any amount that you want. What happened after the $14,000 for those who are not spouses? For example, you want to give it to a friend or to a cousin, to a relative who are not your spouse, over $14,000. There is no tax for US citizens and US residents. There is no gift tax, even though they gift a lot of money up to $11 million. Because there is something that is called the estate tax exemption. The estate tax exemption and the US gift tax exemption work hand in hand. You can use one when you are living, the gift tax exemption. When you are alive, you can give any money up to $11 million and you pay no taxes. Because once the $14,000 of the gift tax is exhausted, it kicks up the next exemption, that is the estate tax for $11 million. So any US expat, any US resident, any US citizen can give $14,000 and it's fine, no taxes will be paid. And above $14,000 up to $11 million, there is the estate tax exemption for US residents and US citizens, only for them. And there is no tax payable for gift above $14,000. What does happen is that if you gift money or property during your lifetime, and when you die, when the person dies, there is already an amount of estate tax exemption used. So if you give someone, let's say $1 million, you give someone $1 million, how much a gift tax you pay? Zero, no tax. But then at the end of the life of the person owns $15 million in property. Out of the $15 million in property, the person has an exemption of not $11 million anymore, only 10, because the person has already used $1 million of gift exemption, gift tax exemption. That's how it works. The $11 million of the state tax exemption works both for the properties that you own after your lifetime, and also for the gift that you give up, or you give to someone, money or whatever property, during your lifetime. We have to picture it that way. $11 million is the cap. I can do up to $11 million and pay no taxes for gift when I die. If I gift $11 million to someone and I die and I have $15 million in properties, I have no estate tax exemption because I already used the $11 million. I will have to pay over the $15 million, 40% of estate tax. That's how they work. If I gift, the tax exemption, excuse me, the gift tax exemption is $14,000. What happens if I gift over 14? Nothing. You pay no tax. But your estate tax exemption of $11 million start to decrease. The more you give during your lifetime, the lower will be your tax exemption, state tax exemption out of the $11 million. That's how it works. So you don't have to worry about gift tax. You can give up to $11 million, but if you have more property after $11 million, you will be subject to 40% of state income tax.
Understood. And how does foreign earned income exclusion work?
The foreign earned income exclusion is an amount fixed that the IRS provides every year. So far, it is close to $110,000. You have to prove that you work for a foreign company in the foreign country and you pay taxes in the foreign country and you are an employee of the foreign country. And you have to provide information of the company, the address of the company, and how much the tax ID of the company in the foreign country, and how much money you excuse me, the company pay you up. You have to prove that in form 2555. That form will allow you to provide the information for the cap of $110,000. This is a credit that is not refundable. It doesn't mean that they are going to pay you for any amount, for any difference. It only means that you will be, the amount will be deductible from your tax return, meaning that it will not be taxed.
Okay.
If you have less than $110,000 earned in income in the foreign country, it doesn't matter. You will only be allowed to exclude the amount that you earn as an employee in a foreign country, employed by a company that pays taxes in the foreign country to the Social Security. That's how you qualify. You have to prove, you have to give to the IRS the proof, including the tax ID of the company, and fill in the form.
Okay, so in this situation, we use form 2555 because that was other question we received.
Yeah, form 2555 also requires that that we will reduce and we did this in the previous video. If you spend less than 365 days in the country, in the foreign country, your foreign earned income exclusion will be reduced. It will not be 365 days because you have not been 365 days in the foreign country. If you stay 30 days outside of the foreign country, you will not have $110,000. It will be prorated. It will be prorated to the number of days that you have spent in the foreign country. That will be, if you spend 30 days in the US or in any other country, you will only have an equivalent of 330 days of foreign earned income exclusion. So the foreign earned income exclusion is reduced by the number of days that you stay outside of the foreign country of your expatriation residence.
Understood. And can you take both for foreign income exclusion and foreign tax credit?
No, you can't. The foreign tax credit is only for the income that is not exempt. Once I take the foreign earned income exclusion, the IRS is forgiving me $110,000. As the income is forgiven, meaning not taxable, I cannot claim the tax that I paid in the country for that income, in the foreign country for that income. I cannot. That will be, it's called double dipping. And I've seen returns that accountants claim the full amount of the taxes. For example, client has salary, client has dividends, client has royalties, consulting income. They claim the full amount of the taxes paid in the foreign country for all of the income that the client declares and reports. But remember, the client already has $110,000 of income exempt. So I have to do a proration, or in other words, I can only claim the amount that does not match or does not correspond to the amount of $110,000 foreign earned income exclusion claim. In summary, no, I cannot claim foreign income tax credit for the amount of the foreign earned income exclusion. No.
Understood. And what housing expenses are excluded from income?
Housing expenses is rent, but you have to prove. You have to send, in the form 2555, you also have to prove the address of your residence in the foreign country and the amount of the expenses that you have in a yearly basis. In this particular case, the housing expense includes only housing that is rent or mortgage and repairs. It does not include any maintenance, any home association or insurance. It is only the rent or the mortgage and the repairs.
I see. And here we have our final question. Do I have to claim foreign income exclusion?
Do I have to pay for any? It is only if you are an employee in a foreign country employed by a company in that foreign country that pay taxes to the Social Security Administration in that foreign country. That's the only way that you are able to claim the foreign earned income exclusion. And it only applies, remember, it only applies to income earned as a salary. Any other income is taxable. And even if it becomes even more, any income beyond the foreign earned income exclusion is taxable at the highest rate.
Understood. Well, thank you, Fulton, for all this information. Now we have more vital information about the taxes, especially about the foreign earned income exclusion. Remember, everybody, we are going to make more videos where we talk about the different tax strategies that you must follow according to your situation. And we will answer all the questions received through our social network and also the ones you may leave in the comments of this video. Don't forget to subscribe to our channel so you can be notified when we publish a new video about taxes. Thank you, Fulton. Thank you, everybody, and see you in the next video. Bye-bye.